I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing what could be one of the best TFSA stock options for monthly passive income. That company being SmartCentres REIT, Walmart's landlord throughout Canada. My guest today is Motley Fool Canada Chief Investment Officer Iain Butler. Iain, thanks for joining me.
Always a pleasure to be here, Nick.
So, Iain, if you were looking to add reliable monthly income to your TFSA right now, and lots of people are, why does SmartCentres REIT stand out to you as a strong contender to have on your radar?
That's right, and rightfully so. It's a tremendous tool that we Canadian investors have is the TFSA, and this is a perfect idea to just stick in there and leave it alone for years. So SmartCentres is anchored by necessity-based retail operations, and these operations provide tremendous stability in most and almost all economic environments outside, I guess, a pandemic, which hopefully we don't see again. Even then, this is a company that's skated by relatively unscathed. So strong results have been posted recently. They've got an industry-leading 98.6% occupancy rate. And the dividend yield is currently about 6.7%, and that is a dividend that is paid monthly. The tenant base, as indicated, super resilient, anchored by big name brands that perform, again, well, regardless of the economic backdrop. These are brands that people go to every day, day in and day out. You broke the secret. The big name behind this company is Walmart. SmartCentres was actually born to be Walmart's landlord, essentially, when Walmart came to Canada so many years ago, and Walmart continues to be the anchor tenant for this company, and to SmartCentres' benefit, they've got a very unique relationship there. But beyond retail, this is a REIT that has been expanding elsewhere. They've recently opened 3 new self-storage facilities, bringing their total up to 14, and they've got some residential development going on. They own a big swath of land at the north end of Toronto, city of Vaughan. They've got a condo tower, which is already 93% pre-sold. This property is right adjacent to a newly constructed public transit hub. There's a new subway stop there. And this is sort of the next leg in SmartCentres' evolution is this development of sort of mixed use property.
Yes, you talk about SmartCentres' strong history of dividend payments, really great numbers when you look at what you're looking for from a REIT, great tenants. And if you look to the future, those tenants looking to spend more in Canada. Walmart recently announced a $6.5 billion expansion. What does that mean for SmartCentres unit holders?
For sure. Yeah. And again, this is a story anchored by Walmart. Walmart accounts for about 23% of rental revenue, for SmartCentre. And Walmart is building dozens of new stores, starting with 5 supercenters by 2027. And this is just going to drive major anchor tenant demand and foot traffic to these properties. The Walmart strategy builds on a previous $3.5 billion modernization investment, and it just shows that Walmart's going to keep growing, and they're going to bring SmartCentres right along with it. So this is a great combination of excellent current dividend yield, 6.7%, and a significant opportunity for ongoing growth to those dividends, but just from a company basis as well, which is, again, perfectly suited to sticking in one's TFSA and just leaving it alone.
That's right. So if you're looking for monthly income, this may not be the biggest performer in your portfolio in terms of percentage return, but reliable income checks each month with really a growth story that's still intact. Iain, thanks so much for joining us for this edition of the 5 Minute Major. Reminder to our viewers, if you want more stock ideas from us, click on the icon in the upper right of your screen. Thanks for joining us for this episode of the 5 Minute Major. Hope to see you next time.